Remember 2008? Lehman Brothers collapsed. Markets crashed, people panicked. It felt like the end of the financial world as we knew it. Newspapers screamed about the impending apocalypse. People were selling their stocks for pennies on the dollar, convinced they'd be living under a bridge by Christmas. But guess what? The world didn't end. In fact, those who kept their cool and stuck to their investment guns actually came out ahead. They bought stocks at bargain basement prices and rode the market back up to new highs. Because that's what markets do. They crash, they recover, they crash again, and then they recover again. It's a bit like my love life, really. The point is, market crashes are scary, but they're also a natural part of the economic cycle. And if you know what you're doing, they can actually be an opportunity to make some serious money. The worst thing you can do during a market crash is panic. When the markets are in free fall, it's tempting to sell everything and hide all your money under the mattress. But trust me, that's the last thing you want to do. Remember, investing is a marathon, not a sprint. The key is to stay calm, think long-term, and stick to your investment strategy. Easier said than done, I know, especially when you see your portfolio shrinking faster than a polar bear in a heat wave. But here's the thing, what goes down must come up. Markets always recover eventually, and when they do, you'll be kicking yourself if you sold everything at the bottom. So take a deep breath, pour yourself a stiff drink, and remember that this too shall pass. One of the most important things to remember when investing, especially during a market crash, is diversification. In layman's terms, that means don't put all your eggs in one basket. Imagine you invest all your money in a company that makes top hats. Suddenly, hats go out of fashion because, let's face it, they're ridiculous. Your investment plummets faster than Richard Hammond in a Reliant Robin. But if you diversified your portfolio and invested in a range of assets like stocks, bonds, real estate, and maybe even some Bitcoin, because why not, then the hat-related crash wouldn't have been so devastating. You'd still have other investments to cushion the blow. Here's the thing about market crashes. They're like a massive sale on the stock market. Suddenly, all those companies you've had your eye on are going for a fraction of the price. It's like walking into Harrods and finding a Ferrari Enzo for the price of a Fiat Panda. Now, I'm not saying you should just go out and buy any old stock that's plummeted in price. You need to do your research and make sure you're investing in companies with strong fundamentals and a solid track record. But if you're smart and do your homework, a market crash can be a fantastic opportunity to buy low and sell high later on. It's like buying a classic car that needs a bit of work. You put in the time and effort, and eventually you end up with a valuable asset. So, you're ready to brave the market crash and snag some bargains? That's a bold move. Good for you. Here are a few top tips to help you navigate the chaos. First, have a plan. Don't just wing it. A well-thought-out strategy is crucial. Figure out your investment strategy before the market goes haywire. What are your goals? Are you looking for short-term gains or long-term growth? How much risk are you comfortable with? Assess your risk tolerance carefully. Having a plan will help you stay calm and make rational decisions when everyone else is losing their heads. Second, start small. Don't throw all your money in at once. It's tempting, but patience is key. Remember, the market could continue to fall for a while. Be prepared for more volatility. Start with small investments and gradually increase your exposure as the market recovers. Third, diversify. Spread your risk. I can't stress this enough. Diversification is your best friend in turbulent times. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographical regions. This way you minimize the risk of losing everything. And finally, think long-term. Market crashes are temporary. The stock market has always recovered from downturns in the past, and it will do so again. Don't panic sell your investments. Stay the course. Ride out the storm and you'll be rewarded in the long run. Patience and perseverance are key to successful investing. History is littered with examples of market crashes, each one seemingly more terrifying than the last. From the panic of 1907 to the financial crisis of 2008, these events have left indelible marks on the economic landscape. But here's the thing about history. It repeats itself. Patterns emerge and cycles continue. And by studying past crashes, we can learn valuable lessons about how to navigate future ones. Understanding the causes and effects helps us prepare better. Take the 1929 crash, for example. It wasn't just a market event, it was a societal upheaval. It was the biggest stock market crash in history, and it triggered the Great Depression, leading to widespread unemployment and hardship. But even after that catastrophic event, the market eventually recovered. It took time, but recovery did come. In fact, those who bought stocks at rock-bottom prices during the Depression made a fortune in the years that followed. They saw opportunity where others saw despair. Or how about the dot-com bubble of the late 1990s? It was a time of great excitement and speculation. Investors poured money into internet companies, convinced they were the future. The promise of the digital age seemed limitless. And for a while, it seemed like they were right. Stock prices soared and fortunes were made overnight. But the bubble eventually burst, and many of those companies went bust. The euphoria turned into panic. However, the market recovered, as it always does. New opportunities arose and lessons were learned. The lesson here is clear. Market crashes are a part of life. They are inevitable, but they also pave the way for new growth. They're unpleasant, but they're not the end of the world. They are temporary setbacks in the grand scheme of things. By learning from the past, we can approach future crashes with a sense of perspective and even optimism. History teaches us resilience and the importance of staying informed. Investing is like driving a classic car across a vast and unforgiving landscape. There will be bumps in the road. You'll encounter unexpected detours. You might even break down a few times. But if you keep your cool, stay focused on your destination, and have a reliable map, or in this case, a solid investment strategy, you'll eventually reach your destination. Just remember, it's not about speed, it's about staying the course. Investing during a market crash can be daunting, but it can also be incredibly rewarding. By staying calm, thinking long-term, and following these tips, you can turn a potentially disastrous situation into a golden opportunity. Remember, investing isn't about getting rich quick. It's about building wealth slowly and steadily over time. It's about making smart decisions, staying disciplined, and never giving up on your financial goals. When the market crashes, most people panic and sell their stocks. They follow the herd, bleating and running for the hills. Don't be one of those sheep. Be a wolf, a cunning, opportunistic predator who sees opportunity where others see only disaster. This isn't about being greedy or heartless. It's about understanding that market crashes are a natural part of the cycle. It's about having the courage to zig when everyone else zags. It's about using your head, not letting your emotions rule your decisions. So when the next market crash hits, and believe me, it will hit, remember, fortune favors the bold. Don't follow the herd, be the wolf. Investing is a long game. It's not about making a quick buck. It's about planting seeds, nurturing them, and patiently waiting for them to grow into mighty oaks. Market crashes are like unexpected storms. They can damage your crops, but they can also nourish the soil, making it richer and more fertile in the long run. So be patient. Don't expect overnight miracles. Stay the course, weather the storms, and in time, you'll reap the rewards of your patience and discipline. Congratulations! You've navigated the treacherous waters of a market crash and come out the other side stronger and wiser. You've kept your cool, stuck to your plan, and even managed to snag some bargains along the way, turning challenges into opportunities. You deserve a pat on the back and a celebratory pint or three, but don't get complacent. The journey is far from over. Remember, investing is a continuous journey, not a destination. It's a marathon, not a sprint. The market will continue to fluctuate, presenting new challenges and opportunities. There will be more bumps in the road, more opportunities, and yes, probably a few more crashes along the way. Each one is a learning experience. But now you're armed with the knowledge and experience to handle whatever the market throws at you, with confidence and resilience. You've learned that crashes are a natural part of the cycle, and that by staying calm, thinking long-term, and sticking to your plan, you can not only survive, but thrive in any market condition. So, buckle up, enjoy the ride, and remember, the finish line is just the beginning of a new chapter in your investing journey.